Trump just told reporters he knows who the next Fed chair will be, and the prediction markets are going absolutely crazy. One name is at 80% odds, and if this guy gets the job, everything you think you know about mortgage rates is going to get flipped upside down. Hi, I'm John Wells, mortgage lender and branch manager with over a decade of experience in the lending space. I've helped thousands of people just like you achieve their goals of homeownership while being budget and wealth conscious. And today, I'm going to break down exactly what's happening with the Federal Reserve, why it matters to your mortgage, and what you need to understand before this change happens in May. So if that sounds good to you, let's get into it. So here's what's going on right now. President Trump was on Air Force One and told reporters that he knows who he's going to pick and that they'll be announcing it. He didn't say the name, but the financial world is already reacting. Treasury Secretary Scott Hassett has been running the search process, and they've narrowed it down to 5 finalists. But one name keeps coming up over and over again: Kevin Hassett. He's currently Trump's director of National Economic Council, and prediction markets are showing an 80% chance that he gets the job. That shot up from 40% just days ago. Now, before we dive into what this means for you and your mortgage, I need to give you some context because people completely misunderstand how the Federal Reserve actually affects mortgage rates. And that misunderstanding is going to cost a lot of homebuyers money over the next year if they're not careful. If you're serious about qualifying for a home and want to know exactly where you stand right now, I've created a free home readiness questionnaire that will show you the exact gaps you need to close before you can buy. I'll put the link in the description. It takes about 5 minutes and it could save you months of frustration. Okay, let's go back to 2017. That's when President Trump, during his first term, appointed Jerome Powell as Fed chair. At that point, Powell seemed like a safe choice. He's a Republican, he was already on the Fed board, and he had a reputation for being balanced and practical. Trump thought that Powell would keep rates low and help the economy grow. But that's not what happened. Fast forward to 2018, the Fed started raising rates, and Trump was furious. He went on Twitter, he gave interviews, and he publicly criticized Powell over and over again. He said Powell was hurting the economy, and he even asked his advisors if he could fire Powell. And the answer is no, you cannot legally fire a Fed chair, so Trump was stuck with him. And this created years of tension between the White House and the Federal Reserve. Then 2020 happened. The pandemic hit, the economy shut down, and suddenly the Fed had to act fast. Powell and the Federal Reserve dropped the funds rate all the way down to near zero. And they also started buying massive amounts of Treasury bonds and mortgage-backed securities. This is super important, and I'm going to come back to that in a minute. But that action of buying mortgage-backed securities is one of the main ways the Federal Reserve actually influences interest rates. But that action, buying mortgage-backed securities, is one of the main ways the Fed actually influences mortgage rates. So from 2020 to 2021, mortgage rates were incredibly low. We saw rates in the 2s and the low 3s. It was historic. People were refinancing like crazy, home prices were skyrocketing because demand was so high and borrowing is so cheap. But then inflation started creeping up. By late 2021, inflation was becoming a real problem. And by 2022, it was out of control. We hit inflation rates we hadn't seen in 40 years. That's when Powell and the Fed made their move. They started raising the federal funds rate aggressively from near zero in early 2022 and took it all the way up to over 5% by mid-2023. And here's what most people don't understand. The federal funds rate is not your mortgage rate. Let me say that again. The federal funds rate is not your mortgage rate. The Fed does not set mortgage rates. So when people say, the Fed needs to lower rates so my mortgage gets cheaper, they're only seeing half the picture. Here's how it actually works. The federal funds rate is the rate that banks charge each other for overnight loans. It's a very short-term rate. Your mortgage, on the other hand, is a long-term, 30 years, 15 years, whatever. Mortgage rates are much more closely tied to the 10-year Treasury yield. And that 10-year Treasury yield is influenced by a lot of things: inflation expectations, economic growth, investor confidence, and yes, Fed policy. But it's not a direct one-to-one relationship. So when the Fed cuts the federal funds rate, that helps short-term borrowing costs. Things like credit cards, car loans, home equity lines of credit, those tend to move quickly. But your 30-year mortgage rate, that's a different story. If the market thinks the Fed is cutting rates too fast and inflation is going to come back, that 10-year Treasury yield can actually go up. And when that goes up, mortgage rates go up too, even though the Fed is cutting. That's a trap a lot of people are walking into right now. Now, here's another tool the Fed has, and this is the one that really moves mortgage rates. It's called quantitative easing. And that's when the Fed buys mortgage-backed securities directly. When they do that, it increases demand for those securities, which pushes their prices up and their yields down. And that directly lowers mortgage rates. The Fed did this aggressively in 2020 and 2021, but in 2022, they stopped. They actually started selling those securities off, which put upward pressure on mortgage rates. So if you want mortgage rates to come down in a meaningful way, the Fed needs to do two things. One, cut the Fed's fund rate, and two, start buying mortgage-backed securities again. That combination is really what creates real relief for homebuyers. Okay, so now let's go back to Kevin Hassett. Who is this guy and why does it matter? Well, Hassett is a 63-year-old economist. He got a PhD from the University of Pennsylvania, and he worked at the Fed back in the 90s as an economist. He spent years at a conservative think tank called the American Enterprise Institute, and he served as Trump's chairman of the Council of Economic Advisors from 2017 to 2019. He came back to the White House this year as the director of the National Economic Council. So he and Trump have had a long history, Trump trusts him, and that matters. Here's where it gets interesting. Hassett is what's called a dove when it comes to monetary policy. That means that he favors lower interest rates and easier credit options. He's been publicly critical of Jerome Powell, saying the Fed was too late to the game on cutting rates. In an interview just a couple of weeks ago, Hassett said that if he were Fed chair right now, that he would be cutting rates because the data supports it. Trump has also been very clear about what he wants. He said publicly that he wants the federal funds rate down to around 1%. That's a massive cut from where we are right now, which is about 3.75 or 4%. Now, if you're a home buyer, you're probably thinking, great, lower rates, that's exactly what I need. And you're not wrong, lower rates would help. But here's the problem. The Fed is not a dictatorship. The Fed chair doesn't just snap their fingers and make policy happen. The Federal Open Market Committee, which is the group that votes on rate decisions, has 12 voting members. Some of them are doves who want lower rates, and some of them are hawkish who are worried about inflation coming back. And right now, the committee is split. In fact, starting in 2026, the rotating members who get to vote are going to have a more hawkish tilt. That means that even if Hassett becomes the chair and wants to cut rates aggressively, he's going to have to convince the other members to go along with it. And if they don't think the data supports it, they're going to push back. That creates uncertainty, and the markets hate uncertainty. Here's the other big concern. If markets think the Fed is just going to do whatever Trump wants, they're going to lose confidence in the Fed's independence. And when that happens, inflation expectations can rise. Investors can start demanding higher yields on long-term bonds to compensate for that risk. And that pushes mortgage rates up, not down. So even if Hassett cuts the funds rate to 1% like Trump wants, your mortgage rate could actually go higher because of the 10-year Treasury yield spikes. And that's the backwards scenario I was talking about at the beginning. Now, let's talk about what could go right. If Hassett gets the job, he's able to build consensus in the committee, and if he convinces the Fed to start buying mortgage-backed securities again, we could see some real relief. Short-term rates would come down, long-term rates would stabilize or even drop. Refinancing activity would pick up, first-time buyers would have an easier time affording homes, and that's the best-case scenario. But it requires a very delicate balance. The Fed has to cut rates without spooking the market into thinking that inflation is back. Treasury Secretary Scott Bessent, who's leading the search for the new Fed chair, has hinted at this. He said in an interview that monetary policy has gotten too complicated and needs to be simplified. He's also talked about rethinking the Fed's mission and the role of regional Fed presidents. That suggests that the Trump administration wants to make some big structural changes on how the Fed operates. That could be good if it makes policy more responsive, but it could also be bad if it undermines the Fed's credibility. If you want to get ahead of all of this and understand exactly how changes in rates affect your buying power, I've got a free down payment ROI calculator that shows you the real return of putting more money down versus keeping your cash in other investments. It's in the description. Run your numbers so you're not guessing. So what should you do as a home buyer or homeowner right now? Well, first, understand that lower Fed rates do not automatically mean lower mortgage rates. You have to watch the 10-year Treasury yield, and if that number is going up, mortgage rates are likely going up too, even if the Fed is cutting. Second, don't wait for rates to hit some magical number before you buy. I've seen so many people sit on the sidelines for years waiting for the perfect rate, and they end up paying way more because home prices keep climbing. Third, if you're planning to buy in the next year, get pre-approved now so you know exactly what you can afford at current rates. Then, if rates do drop, you can refinance later. Here's the reality. The next Fed chair, whether it's Hassett or someone else, is going to inherit a really tough situation. Inflation is still above the Fed's 2% target, the job market is softening but not collapsing, and economic growth is strong but uneven. And there's massive political pressure to cut rates fast. Balancing all of that without making a major mistake is incredibly difficult, and whoever gets the job is going to be under a microscope from day one. One more thing to consider, Trump made it very clear he wants lower rates for housing. He said that the current Fed policy is hurting the housing industry very badly. And he's right that affordability is a massive problem right now. But the solution isn't as simple as just cutting rates. If the Fed cuts too fast and inflation comes back, we're right back to where we started, except now people have even less confidence in the Fed's ability to manage the economy. That makes everything worse in the long run. The announcement is expected to come before Christmas, so the next few weeks we're likely going to know who the next Fed chair is, and once that happens, the markets are going to react. You're going to see a lot of headlines, you're going to see a lot of predictions about what this means for rates. My personal advice, don't make any major financial decisions based on headlines. Make them based on your actual situation, your timeline, and the numbers that apply to you. Here's a quick recap. Trump is about to announce his pick for the next Fed chair. Kevin Hassett is the frontrunner. He's a dove who wants lower rates that could help with affordability. But the Fed doesn't directly control mortgage rates. They control the federal funds rate, which is a short-term rate. Mortgage rates are tied to the 10-year Treasury yield, which is influenced by inflation expectations and market confidence. If the Fed cuts too fast and the market loses confidence, mortgage rates could actually go up. The Fed also needs to start buying mortgage-backed securities again to really move the needle on mortgage rates. And the Fed chair is going to face a divided committee and a lot of political pressure. So it's going to be messy. But if you understand how all of this works, you can make smarter financial decisions and you can avoid the mistakes that most people are making right now. Before I go, I want to answer a question from the comments. Last video, somebody asked, John, if mortgage rates are tied to the 10-year Treasury, why don't lenders just match that rate exactly? And that's a great question. And the answer is something called the spread. Lenders add a spread on top of the 10-year Treasury yield to cover their costs, their risk, and their profit. Right now, that spread is historically wide. Normally, it's about 1.7 to 2% above the 10-year Treasury. But recently, it's been closer to 3%. And that's because lenders are baking in a lot more risk right now. They're worried about defaults, and they're worried about higher costs. They're dealing with higher costs, and they're not seeing as much competition. So even if the 10-year Treasury yield drops, your mortgage rate might not drop as much because that spread is staying wide. That's another reason why just watching the Fed isn't enough. You have to watch the whole picture. And listen, if you like this video, you'll love the next one. I'll see you there.